Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, let's decode the world of real estate development. Ready?
Let's do it.
Today, we're going deep on proformas.
Ooh, exciting.
Or proformas, you might be thinking, pro what now?
Yeah, I can see that.
But trust me, even if you're not out there building a skyscraper empire,
Right.
this stuff is seriously fascinating, we promise.
Absolutely.
We've got a whole stack of sources
Yeah.
that unpack how developers actually decide which projects are even worth pursuing. Think of it like a financial detective story, but for buildings.
I love that.
What's really cool
Yeah.
is that understanding proformas can give you a whole new perspective on the real estate that you see every day.
Totally. It's like peeking behind the curtain
Yeah.
to see the financial forces that are actually shaping our cities.
So let's start with the basics. What exactly is a proforma?
Right.
Is it just a fancy word for a budget?
Well, it's definitely a budget, but it's got a superpower.
Ooh, a superpower. I like it.
Yeah, it's kind of like this financial model that predicts the future of a real estate project. Oh, wow.
It lays out all the costs, the potential revenue, and ultimately whether a project is going to be a financial home run or a total flop.
So it's not just about crunching numbers, it's about making decisions, right?
Big decisions, yeah.
Big decisions based on those numbers.
Exactly. And, you know, those decisions, they have huge consequences.
Yeah.
Developers use proformas to secure financing from banks, attract investors, and even just to figure out if a project is worth pursuing in the first place.
So in our sources, they actually break down a proforma into two main parts, right?
They do, yeah.
The sources and the uses. So the sources are where the money is coming from,
That's right.
and the uses is where that money is going.
Makes sense.
Yeah.
You got to know both sides of that equation.
But before we get lost in a spreadsheet spiral, can we talk about the different approaches that developers take? I mean, not every project is the same.
Oh, absolutely not. Every project has its own personality.
So our sources outline three main strategies: develop and sell, develop and hold, and a hybrid of the two.
So imagine, like, a developer building a condo building and selling off each unit. That's like the classic develop and sell, right?
Textbook, yep.
And their proforma is going to be laser focused on maximizing those sale prices
Yep.
and minimizing that time to sell.
Gotta move those units.
Yeah, time is money.
For sure.
What about develop and hold?
So think of it like this. A developer building an apartment complex, and they're renting out those units for the long haul.
Right, so they're playing a different game.
Totally different game. They're in it for the long game.
Their proforma is all about predicting that rental income,
Right.
operating expenses, and the long-term value of the property.
You got it.
So they're thinking about cash flow over time rather than one big payout.
Exactly.
Now, the hybrid approach, that's where things get interesting.
That's where the fun begins.
So imagine a mixed-use project, right,
Okay.
with retail spaces on the ground floor that are sold off, and apartments above that are held for rental income.
Interesting. A little bit of both worlds.
It's a juggling act.
Yeah. You got to balance those two sides.
So their proforma has to account for both of those things.
Absolutely. You got to wear two hats at the same time.
It's so cool.
It is, yeah.
Even just walking down the street, you start to see these different strategies playing out in the buildings around you.
Oh, totally. You start to see the city in a new light.
Now, our source material keeps hammering home the importance of timelines.
Yes.
Why are those so crucial?
Well, a realistic timeline, it's the backbone of any accurate proforma, right?
Right.
And accuracy is everything.
Developers need to know when they can expect certain costs to hit,
When those milestones will be met, yeah.
when those revenue streams will start flowing.
It's all about timing.
It's like a domino effect, right?
Yeah, one delay can throw everything off.
Our sources actually had this table of common events in a development timeline.
Yeah, it's helpful to see it all laid out like that.
Things like permitting, construction,
Yeah.
sales, leasing.
It's a complex dance.
with a lot of moving parts.
A lot of moving parts.
Okay, so we've got our timelines in place, but let's be honest. The thing everyone really wants to know about is the C word, right?
Oh, yeah. Costs. Gotta love them.
The source material breaks it down into two main categories.
Yeah, hard costs and soft costs.
Hard costs, those are like the tangible things.
Things you can see and touch, yeah.
Construction materials, all those bulldozers and cranes.
Exactly.
Soft costs, those are a little less visible.
Yeah, but equally important.
Things like architectural fees, permits, legal fees, insurance.
Can't forget about those.
I bet there are some sneaky costs that people don't even think about
Oh, for sure.
until they're staring them in the face.
Absolutely.
So our sources, they highlighted a few that might fly under the radar.
Okay.
Things like holding and running costs.
Ah, yes, those can sneak up on you.
Imagine you're a developer, you've acquired this land.
Mm-hmm.
Construction hasn't even started yet,
Right.
but you're still paying for things like property taxes, insurance, maybe even security.
All those things add up.
It's a slow burn.
A slow and steady drain.
And then there's connecting to all those essential services, right? Water, sewer, electricity, gas.
It's a whole other project in itself.
You're telling me.
Yeah, and it comes with a hefty price tag.
So, okay, we've got a good grasp on the costs involved, but how do developers actually finance these massive projects?
Right. It's a good question.
I mean, not all of us are sitting on a Scrooge McDuck-sized vault of gold coins, right?
Sadly not.
Most real estate developments rely on a mix of debt and equity, right?
They do, yeah.
Debt is essentially borrowing money, usually from banks, in the form of loans.
Right, putting those bankers to work.
And equity is the developer's own skin in the game.
Their own contribution.
Or money invested by partners.
Yep. Got to share the risk and the reward.
Our sources mention something called the loan-to-cost ratio, or LTC.
The LTC.
What's the deal with that?
So the LTC, it's kind of like this financial balancing act, right? It's the percentage of the total project cost that's financed through debt.
So a higher LTC means the developer is using more borrowed money.
Exactly. More leverage.
Which can amplify both profits and losses.
It's a double-edged sword.
High-stakes game.
It is, yeah.
I'm starting to see why lenders scrutinize those performas so carefully.
They definitely do. They want to see a clear path to profitability.
Yeah.
Which means realistic cost projections, solid revenue forecasts.
A rock-solid timeline.
Can't forget about that timeline.
Yeah, so our sources also dove into the different types of loans.
Oh, yeah, there are a few.
That developers typically use, right?
Right.
Land acquisition loans, construction loans, permanent loans.
Each one has its own quirks and terms.
This is already so much more than just crunching numbers. It's a whole financial ecosystem.
It really is. It's a whole world unto itself.
Okay, so after all of this number crunching, how do developers actually measure whether a project is a success?
Right.
What are those key metrics?
So that's where we get into the profitability metrics.
All right, let's talk about those.
First up, you've got gross realization value, GRV.
Okay, GRV.
That's the total projected revenue from sales if you're going the develop and sell route.
Right, and then there's total development costs, TDC.
TDC, yep. That's the grand total of all those expenses.
All those expenses we've been discussing, wow.
It all adds up.
So I'm guessing those two numbers play a big role in determining the profit margin.
You got it. The development margin is simply the profit expressed as a percentage of the total development costs.
Makes sense.
It's a quick way to assess how attractive a project is.
But isn't there also a metric that considers the time value of money? I mean, $1 today is worth more than $1 tomorrow.
Oh, for sure. You're thinking about the internal rate of return, IRR.
IRR, right?
It takes into account the timing of cash flows both coming in and going out.
Over the entire life of the project.
The whole thing, start to finish.
So a higher IRR generally means a better return on investment.
That's the idea.
Right. So the Proforma helps developers determine whether that IRR is high enough to justify the risks.
And that big capital investment.
Wow. This is all starting to make sense.
It's all connected.
But I'm sure there's even more to explore.
Oh, yeah, we're just getting started.
Buckle up, everybody. We'll be back with part 2 of our Proforma deep dive after this.
Can't wait.
Welcome back, Proforma adventurers.
Back for more.
We've laid the groundwork, and now it's time to get specific, right?
Let's do it.
We talked about those different development strategies.
The different approaches.
Turns out each strategy actually has its own type of Proforma.
Oh, yeah, they're tailored to each approach.
Who knew?
It's all about those specific goals and challenges.
Let's start with the develop and sell Proforma.
Okay, the classic one.
This one is all about projecting that sales revenue,
Got to know how much you're going to make.
timing those sales just right,
Timing is key.
and of course, nailing those all-important construction costs.
Can't forget about the costs.
If you're building condos to sell, you need to know exactly how much it's going to cost to build each unit, right?
Before you can even think about pricing.
Before you can even think about pricing.
Yeah.
Our sources actually walked us through an example
Oh, cool.
of how those construction costs are calculated.
It's more complex than you might think.
It's not as simple as just like slapping an average cost per square foot
No, not at all.
on the whole project.
Developers, they get granular
They get granular, breaking down costs.
based on specific features and finishes of each unit.
So they might say, okay, the kitchen in this unit,
Yeah.
it's going to have granite countertops, custom cabinets,
Fancy.
so that's going to cost us X amount per square foot.
Right.
While the bathrooms are going to have standard fixtures, so that's Y amount.
It's all about the details.
It all adds up. It's like a financial jigsaw puzzle.
Piecing together those costs for each little element.
But even with the most meticulous cost calculations, things can still go wrong.
Oh, absolutely. Construction is full of surprises.
Construction delays, material prices fluctuate.
You never know what's going to happen.
Seems like there's a lot of room for error.
That's why developers build in contingency factors.
Contingency factors, okay.
A little financial cushion.
To absorb those unexpected bumps in the road.
Gotta have a buffer.
They also have to be savvy about timing those sales, right?
Oh, yeah. Time is money, remember.
The longer it takes to sell those units.
The more those holding and running costs eat into those profits.
Speaking of sales.
Yeah.
Let's talk about how developers figure out what those units can actually sell for.
Ah, the pricing game.
They can't just pull a number out of thin air.
Nope. Got to do their research.
They have to be real estate detectives,
Analyzing the market.
looking at comparable properties,
Seeing what buyers are willing to pay.
things like location, amenities.
The overall quality of the finishes.
It all comes into play.
You got to appeal to the target market
So it's not just about building a beautiful building. It's about building the right building
for the right buyer.
for that specific market.
Location, location, location.
And of course, those pesky sales commissions.
Can't forget about those.
Our sources even showed how those commissions can be paid up front,
Oh, interesting.
which seems counterintuitive, but I guess it helps with the cash flow projections.
Yeah, it's all about managing that cash flow.
Okay, so we've tackled the develop and sell pro forma.
We conquered that beast.
Let's shift gears and explore the world of the operating income pro forma.
A different beast altogether.
This is the one for those long-term rental projects, right?
That's the one. Think apartment buildings, office complexes, even those self-storage facilities.
Yeah, those are popping up everywhere.
They are. The focus here is on projecting that rental income.
Okay, rental income.
Understanding those operating expenses
Mhm.
and maximizing that long-term value.
So the first step is figuring out how much it's going to cost to build the darn thing.
You got it. Construction costs are constant,
Just like with the develop and sell.
no matter the strategy.
But with this operating income pro forma.
Yeah, we're looking at those leasable units.
Okay, the money makers.
Those apartments, office spaces, those storage units.
What happens after you've got a handle on the construction costs?
Then it's time for the exciting world of potential gross operating income.
Potential gross operating income.
Projecting that monthly rent for each unit, factoring in any periods of free rent, those concessions.
Oh, right, to attract tenants.
And even anticipating how much rent might increase each year.
So it's like a financial crystal ball.
Trying to predict the future of that rental income.
It's a mix of market analysis, a little bit of guesswork, and a whole lot of number crunching.
You gotta use all the tools in the toolbox.
But even with the most optimistic rent projections, things don't always go according to plan.
That's the reality of real estate.
That's where vacancy rates and potential credit losses come in.
You gotta be realistic.
No property is going to be 100% occupied 100% of the time.
And even the best tenants can run into trouble.
Developers have to be realistic about those factors, right?
Absolutely, when projecting that effective gross revenue, or EGR,
EGR, the more grounded, real-world version
that's the one.
of that potential gross income,
The income you can actually count on.
after accounting for those vacancies and potential losses.
Gotta be prepared for the unexpected.
So once you've got that EGR, it's time to calculate the holy grail, right?
Oh, yeah.
Net operating income, or NOI.
NOI, the lifeblood of these projects.
Investors drool over it.
Lenders scrutinize it.
It determines the value of the property.
It's a big deal.
To calculate NOI, you subtract those operating expenses from the EGR.
That's the formula.
Operating expenses, remind me what those are again.
Property taxes, insurance, maintenance, utilities, property management fees.
All those costs associated with keeping the property running smoothly.
Got to keep those tenants happy.
So NOI is essentially the profit generated by the property before taking into account any debt payments.
You got it, the pure income-generating power.
But hold on tight. The pro forma journey doesn't stop there.
Oh no, we're just getting warmed up.
We've got more metrics to explore.
More calculations to conquer.
Next up is cash flow from operations, or CFFO.
CFFO, taking NOI a step further.
It takes NOI and subtracts those capital expenditures.
Those big-ticket expenses.
Like replacing a roof or upgrading those old elevators.
Gotta keep the property in tip-top shape.
So CFFO shows the cash flow that's actually available to the owner.
After covering all those essential expenses,
Big and small.
every penny counts.
Now for developers who are planning to sell the property eventually.
Yeah, the exit strategy.
There's one more crystal ball calculation to consider, right?
Oh yeah, we gotta look into the future.
End sale value.
Also known as the reversion value.
How do you even begin to predict what a property will be worth years down the line?
It's a bit of an art and a science.
Market analysis, a dash of speculation, a healthy dose of number crunching.
Gotta use all the tools in the toolbox.
Developers use a projected capitalization rate,
Or cap rate, for short.
which reflects that expected rate of return for similar properties.
Gotta know what the market's doing.
It's a way to estimate what a future buyer might be willing to pay.
Based on that anticipated income stream.
This is starting to feel like a very elaborate financial puzzle,
It is, but it all fits together.
with each piece revealing the overall picture.
The financial story of the project.
But just when you think you've got all the pieces in place,
Oh no, there's more.
there's one more layer to add to the mix.
Hit me with it.
Debt service.
Ah, the elephant in the room.
That's the money needed to make those loan payments, right?
Gotta pay back those loans.
Those payments can have a significant impact on the overall profitability.
Interest rates and repayment schedules can really eat into those cash flows.
So how do developers make sure they're not drowning in debt?
They gotta be smart about it.
How do they incorporate that into their performance?
They subtract it from the cash flow from operations to arrive at the before-tax cash flow.
Before tax cash flow.
This shows how much cash is left over.
After covering all those operating expenses and those debt payments.
It's getting real now.
But wait, there's more.
More. Bring it on.
We can't forget about Uncle Sam.
Oh yeah, taxes.
Those taxes on the project's income have to be accounted for.
Gotta pay your dues.
That final step involves calculating the after-tax cash flow.
The true bottom line.
The amount the developer can actually expect to pocket.
After all expenses and taxes are paid.
Wow, we've covered so much ground.
We've been on a pro forma roller coaster.
It's amazing how much goes into these pro formas,
It's a whole financial symphony.
with all these different instruments playing their part.
It's all connected.
The beauty of it is,
Yeah.
once you understand how these pieces fit together,
You can start to decode those financial stories.
behind the buildings.
It's like having X-ray vision for real estate.
I love that analogy.
It's a powerful tool.
We've explored the nitty-gritty
We got our hands dirty.
of the develop and sell
Mhm.
and the operating income pro formas,
Two different beasts.
but there's still one piece of the puzzle missing.
Oh, what's that?
The big picture summary.
It's a grand finale.
Get ready to zoom out, folks.
We're wrapping up this pro forma adventure.
In part 3. Welcome back, Pro Forma Pros. We've journeyed through the intricate world of development strategies, dissected those cost breakdowns, and even mastered the art of projecting operating income.
And now it's time to step back and admire the masterpiece.
The Real Estate Development Pro Forma Summary.
Yes.
Our source material actually called it a detailed development summary.
Mhm.
And it really does live up to that name. What is this summary all about?
It's like the executive summary of a business plan, but for real estate.
Okay.
A comprehensive snapshot designed to showcase the project's financial viability and really entice investors.
Okay, so think of it as a highlight reel.
Yes.
Showcasing all the reasons why this project is a must-invest opportunity.
You got it.
So it usually starts with those basic project details, right? The name, location, and that anticipated timeline.
Yep, setting the stage.
Yeah.
Giving investors a sense of the project's scope and ambition.
Then you move on to painting a vivid picture of the project itself, right?
Absolutely.
Highlighting its unique features and those selling points. So, is it a luxury condo building with those breathtaking views? A state-of-the-art office complex designed for the future of work?
Ooh, I like that.
A mixed-use development that revitalizes the neighborhood? This is where you capture the imagination of potential investors.
Absolutely. You're selling a vision, a story. You're not just selling bricks and mortar.
And then it's showtime for the numbers. What kind of financial stats are we talking about here?
This is where you bring out the heavy hitters: profit before tax, development margin, and the equity multiplier.
Equity multiplier. That one sounds intriguing. What is that all about?
It's a way to measure how effectively the developer is using borrowed funds to amplify their returns.
Yeah.
Think of it as a leverage ratio.
Okay.
A higher equity multiplier generally means that the developer is using debt strategically to boost those profits.
So it's not just about how much money you make.
Right.
It's about how efficiently you're using borrowed funds to make that money.
Exactly. And of course, no pro forma summary would be complete without those investor favorites: the internal rate of return, IRR, and the net present value, NPV.
Ah, yes, those metrics that take into account the time value of money.
Right.
So these are all about understanding how those future cash flows translate into today's dollars.
Precisely. A higher IRR and a positive NPV are generally music to an investor's ears.
And they signal that the project is expected to generate attractive returns, even after factoring in that time value of money.
Right, because time is money.
To really drive that point home, a well-crafted pro forma summary often includes a visual timeline, right?
Yes.
Or a Gantt chart.
The Gantt chart, our trusty roadmap for the development process. It's a powerful way to show investors and lenders how the project is expected to unfold, with key milestones and anticipated completion dates clearly laid out.
It's like a visual progress report, showcasing the developer's commitment to staying on schedule and delivering on those promises. But the heart and soul of any pro forma summary is the breakdown of sources and uses of funds. This is where the rubber meets the road.
Yes.
Demonstrating that you have a clear plan for financing the project and that the numbers actually add up.
Transparency is key.
It's like that classic pro forma equation. Debt plus equity equals project costs.
It all has to balance out.
And to make it even more digestible, a good pro forma summary will break it down into those revenue and cash flow summaries. Investors want to see those projected income streams and how those cash flows will cover expenses and debt payments.
It's all about painting that clear picture of the project's financial performance.
Our source material even mentions separate pro forma summaries for residential and commercial projects.
Oh, that's interesting.
Yeah.
It makes sense, though. Those different project types often have unique revenue models and expense categories.
So a residential pro forma might focus heavily on that sales revenue from those individual units, while a commercial pro forma might emphasize long-term rental income from office spaces or retail tenants.
You have to tailor the summary to those specific nuances of the project.
It's all about telling the financial story in a way that resonates with potential investors and lenders.
And that's the power of a well-constructed real estate development pro forma. It guides decision-making, attracts investors, and ultimately helps bring those ambitious projects to life.
This has been an incredible deep dive. We've demystified pro formas, explored those different types, and even learned how to read those all-important summaries.
I hope our listeners are feeling empowered to approach real estate development with a newfound understanding and excitement.
And remember, this knowledge isn't just for developers. This is for anyone who wants to navigate the world of real estate with more confidence. Whether you're buying an investment property or just curious about how those massive projects get off the ground, understanding pro formas gives you a valuable edge.
So the next time you see a construction site, think about that intricate web of financial projections and calculations that went into making it a reality.
We've had a blast exploring this topic with you, and we can't wait to embark on our next deep dive together. Until then, happy learning.